In today's case study, we're going to look at an individual who's taking out a whole life insurance policy to, number one, maximize the cash value, and then number two, use the cash value. Specifically through policy loans, he has plans to firstly pay off car loans he has, and then secondly, use the policy for hard money lending. He's seen others do this successfully. It's something he is interested in, and this is a big reason why he's looking to maximize the cash value of the policy so he can then use it. So in this case, we've got an individual who's reviewed multiple companies and products. We looked at a lot of different options, and he had done his due diligence before even connecting with us. He had done a lot of research. So we've looked at multiple companies and life insurance products. His choice was Guardian. The main reason why had to do with PUA flexibility, but an additional reason was that they're one of the major mutual companies. So he wanted a quality company, but he also wanted to make sure he had PUA flexibility, because you'll see the funding amount that he's considering is quite large. And also his income has fluctuated quite a bit historically. So as the years pass, he doesn't want to be in a position where the policy feels like a burden to him, where he's on the hook to make a large payment, or he can only make payment adjustments one time per year. He really wants to be able to use the policy as a flexible savings asset from a funding perspective, and then still be able to access the cash value when it comes to policy loans, which we're going to look at both in this case study. So what we're going to look at is building the policy and then reviewing different options. We're going to look at one product here because, again, he narrowed things down to the company and product that he'd like to go with. Now we need to build it, but then look at different options. Specifically, what does it look like if he's able to fund it with a lot of money? Here's the target amount where things will look fantastic if you get this dollar amount in. But what happens if life happens and you can't get the desired amount in? How much does that negatively impact the policy? That's the information that is very beneficial to be aware of up front. So what we've got, age 60, this is when he's starting the policy. He presently has a lump sum of $400,000. He's got more than that, but this is how much we're looking to dedicate to the policy initially. When I say initially, at his age, it makes sense to break that lump sum up over 2 years. So you'll see the first and second year, $200,000 is going into the policy. That's the annual payment. Now, we mentioned this briefly earlier. His income fluctuates. There's been years he's done very well, but other years, not quite as well. My point is, he doesn't want to commit to a large policy where he's on the hook to fund $200,000 or even $100,000 every year. We looked at that example, an example of funding $200K years 1 and 2, and then $100K per year thereafter through year 10. And he saw that and said, that makes me nervous. I might be able to do it, but he's nervous about it. So I'm going to talk through exactly how we set the policy up so he can hit the 100 if he wants to, but he's not obligated to it. His annual funding, what he feels he can do, is somewhere between that $20,000 and $100,000. The minimum commitment will be about $20,000. And I'll add this, when I mention that, saying you've got a policy where you can fund $200,000 per year in the first 2 years, you've got the funds to do that now, and then you can commit to $20K per year thereafter. That was something where his reaction was, oh, okay, I'm good with that. Based on his income, even during low years, that's a number that does not stress him out, which is very, very important when you're looking at funding a policy. Continuing on, the policy specifically, first year, $200,000. Second year, $200,000. Years 3 through 10, anywhere from $0 to $100,000. He said, I can do $20K per year. Why I have a 0 here is because during our call, I asked, would you like to see an option, or would it provide peace of mind more or less? I phrased it somewhat like that, I can't recall. Would you like to see an option if you got the $400K lump sum in only and then never paid anything thereafter? And he did. That intrigued him, and we talked about that for a bit just to provide some additional peace of mind. Meaning, what if you get the lump sum in and then everything goes south and you can't get anything into the policy? Then what happens there? Will the policy still work? Fun stuff, right? We're going to look at numbers. What I'll mention before we look at the numbers is we're also going to look at loans. But first, we'll focus on growth. The most important thing before looking at loans is the design of the policy and making sure we have the cash value maximized. Because if this is maximized first, loans are easy. When people have regret or express any type of remorse about a whole life insurance policy, it's rarely the loans. It's always, why wasn't this maximized more so I have more cash value and or have more money to access through policy loans? That's typically the source of buyer's remorse, not having that cash value maximized right out of the gates. So let's take a look here. And again, with these different options, we've got one policy, but what we're going to see is different funding scenarios. So call it different what-if scenarios. What does the policy look like if you only get the lump sum in? If you pay $20,000 per year, if you pay $100,000 per year. Let's take a look. So we'll begin with an illustration so we can see the design of the product. And again, all the variations will be identical from a design standpoint. So if this is you want to make sure this policy is set up for maximum cash value, what should you be looking for? Because there's a lot of information on here. A lot of times people look at these and say, all right, this is too much, I'm overwhelmed. What's going on here? So, net after-tax outlay. This is how much you're funding the policy with. We've got 10 years. I asked him about funding longer. He'll be about 70 then. He said, probably not. If I want to, can I? Yes, you can keep paying the premium, but after 10 years, the likelihood is that he's not going to want to continue to fund the policy, at least based on our conversations right now. So funding, 200, then 100 per year thereafter. So if you see 100K per year, does that mean you have to pay that according to the illustration? No, not if it's set up correctly. If it's all premium, then yes, you would have to. But here's how it's set up. Here's the premium. That's what is referred to as our base premium. Down here, we have a term insurance rider. What we're committed to are these two together, the premium and the term rider. That is my true minimum out of pocket. We had $20,000 before. It's about that. It's a little bit more here. But what happens with this term rider, in this particular case, you actually see the cost gradually decrease over time because the amount of the term rider is going down. So what we've got, minimum commitment, but then the rest is being plowed into PUAs in order to maximize the cash value. Net cash value is your money column. When's your break-even point? Just about year 4. And remember, this individual is 60 years old, breaking even year 4, starting at age 60. Sometimes an individual in their 60s will say, am I too old? Like it's going to take a long time for this to work, isn't it? No, not necessarily. Not if we set it up like what we see here, where we've got minimum expenses and the cash value is maximized. We've got the death benefit at the minimum amount needed in order to pay in $200,000, because that gives us a MEC limit of, guess what? $200,000. That's our taxable line on a policy. So, illustration there, nuts and bolts. Let's look at a simplified version of this. Number 1, what's it look like if you don't pay anything after the lump sum? 2 payments of $200,000, then 0. And I'll add here, his premium is still due every year. It's due through year 7. He's not paying it, but it's still due. Break even between years 4 and 5. Check that out. If you're able to max fund a policy, 10x the base premium and fund up to the MEC limit for the first and second year, that's going to put you in a very, very good position where it is difficult to fail. The policy will break even early. The internal rate of return will be strong. It'll perform nicely. That typically results in a high level of satisfaction from a performance standpoint. Again, if I'm able to max fund it during the first and second year of a policy. And we can see that here because we've got an individual starting at age 60. He's not paying the premium or the term rider cost. The policy's covering that and still appreciating in value. It's because he max funded it in years 1 and 2. But this again is an example of the policy with really a minimum amount. the money he has in cash right now, getting into the policy over 2 years. Then we've got 200, years 1 and 2, and then just the minimum premium thereafter. Break even, same thing. Next year, or next scenario, 200K per year, 2 years, then 50 thereafter. So in this particular case, what he can do, and he can do this from day one actually, is commit to the approximate $20,000 amount of base premium and cost of term. It's a little bit higher than that, but he can commit to the minimum and add excess funds at discretion. So here, beginning year 3, can be set up where he's only billed for 20 and then can add an additional 30 over the course of the year to hit that total of 50K. And some years it might only be 20. You can go back and forth here. This is the same policy, but demonstrating what it looks like if he adds more or less dollars to it. And then we've got the 100K sample, which is what we just looked at. So again, the purpose of this is to show him the one policy that he's interested in because he's narrowed things down based on the company and product. Now he just wants to know, what does it look like if I'm able to aggressively fund it with what I feel is realistic, pay just a minimum premium, or everything goes south and I can't pay anything in. And he might fund a different variation of this because he can adjust as he goes and we would track the performance over time. But again, this gives him just a snapshot of what things look like if he gets different dollar amounts in. Pretty interesting, isn't it? I know I'm interested in this stuff. So that's an overview of the growth. Let's take a look next at the loans. What we'll look at first is a direct recognition loan. This is a direct loan from Guardian, and then we'll look at a cash value collateral loan, which is a lot like a line of credit. We're just assigning the cash value as collateral. So a direct recognition loan with this Guardian policy. So here's how it works. Dividend rate for 2023 is 5.75%. Now that's not what the policy is actually growing by. That's the gross dividend rate. But that is applied to any money in cash value, any non-borrowed cash value. If you elect to borrow, the loan rate with Guardian is fixed, and it's fixed at 5%. However, if you are paying the loan interest out of pocket annually, it's actually a discounted rate of 4.76%. What Guardian does on the loan dollars, so let's assume you loan $50,000. Let's say you've got $50,000 remaining. So pre-loan, you're at 100. That's where I'm going with this. You had 100 to start. You borrowed 50. That means there's 50 remaining in equity. You continue to earn dividends on the full 100, but here's the difference. The borrowed funds, what Guardian does is apply a dividend. It comes out equivalent to a dividend of about 4.5% on the borrowed money, and then a 5.75 dividend on the non-borrowed cash value. Thing to keep in mind, we're paying a low fixed loan interest rate there at 4.76%. But in a case like this, where we look to borrow and then repay, what you're going to find is that the cash value will be less than what it would be if I didn't touch it in the first place. So if he doesn't like that, the alternative would be the cash value collateral loan, which would be very, very similar to a non-direct recognition policy. But let's look at the direct recognition loan first. Here we go. Fun stuff, right? What we've got on the left is the growth illustration. So here, we've got the 100K sample, meaning 200K years 1 and 2, then 100K thereafter. Here's your break even. This is growth. Anytime we look at a loan, especially if it's going to be direct recognition, seeing the growth illustration is extremely helpful because I can see side by side what the exact difference in value is. So here, we're looking at a loan early on in policy year 2, because he did ask how early can I borrow against the policy. It can be in year 1. The earliest we can illustrate it is in year 2. So year 2, no loan, $377 and change. Takes a $300,000 loan. the cash value drops by approximately $300,000 when we look at it there. What happens to the death benefit? That also drops by how much? Well, look at that, $300,000 by the amount of the loan. Now in this example, we're assuming we pay the loan interest annually. So first year, where the number comes from, 4.76%, that's the fixed rate. So we're paying the interest annually, and then also paying the principal. Now in a case like this, after showing this, right, if this is you, what might you ask? If this gave you the feeling of, it might be a bit high, maybe the funding, we kick down to 50K. That way I can apply $50,000 per year toward the loan principal, if that's what I want to do. We can look at different numbers there. But in this example, we're just going to look at paying the loan back at $50,000, while at the same time, he's funding it at the 100. So that's aggressive, but the purpose is to demonstrate what happens with the loan. So here, year 8 is repaid. What is the cash value and death benefit once it's repaid? It's restored minus a little bit here. Not a whole lot relative to the dollar amount, but I do see that it is less. And the reason why is because what's happening, the dividend applied, again, to the non-borrowed funds, 575, whereas over here, it was about 4.5%. So the decreased dividend results in a little bit of decreased value. Death benefits restored because we've got them equal at this point in time. But after the funding, like look at let's look at 875. Cash value and death benefit are a little bit less. Now relative to the dollar amount he's paying in here, when he saw it, it was kind of like, all right, like that doesn't really bother me there. And I don't know that I'm going to be able to find a fixed loan interest rate of under 5%. So we also need to factor that in to the decreased value. Yes, it's a slightly decreased dividend rate, but at the same time, you're getting a much lower loan interest rate that's also fixed, so I don't have to worry about that going up on me over time. But that is a direct recognition loan example. If you took out more loans or held the loan for a longer period of time, that will impact the difference. So we do want to have awareness of that. Let's look at the collateral loan, shall we? Okay, so here, what I'm going to do is simplify this just by getting rid or condensing the extra stuff we've got here. I like the extra stuff, but we're going to simplify. All right. Cash value collateral loan, this will be higher. Let's assume the rate's 6.5% right now. But it won't impact my policy value at all because I'm not borrowing directly against the policy with direct recognition. So what I've got here, take the $300,000 loan. Let's repay it exactly the same, not at $50, but $50,000 until it's repaid. Here we go. What's nice about this, and we can do this with a direct policy loan as well, we could paste these formulas on the last workbook. You can do, or what's nice about this is you can look at this. Your yearly cash value growth and your total gain on cash value compared to what you're paying in loan interest, and then also the total interest payments. And I can compare the two side by side. So if you take a loan early on in year 2, the gains are not that much. They're $2,600. And 6.5% of $300,000, $19,500 in interest you're paying. Did it benefit you that year? No, you paid more in interest than what the policy produced in gains. Now, what's happening is you're paying the loan down, so it's going to chip away at the balance, and then the interest is applied to the balance, but if you've got a lower balance, you're going to pay less in interest. This example, it's about by year 4, or on a year-by-year basis, it's about a wash. And then from that point forward, you're ahead, meaning you're gaining more than what you're paying in loan interest, because compounding is on the total cash value, where the interest paid is only on the outstanding loan balance. Now, to be fair, we're compounding on this entire cash value and paying interest only on the $300,000. What happens if we extend this or don't pay it back while we are funding? Let's assume he takes that $300K loan. Then in year 6, takes another $400,000, pays interest only. And then after the funding, he begins to repay it at $50 a year. $50 toward the principal, in addition to the interest payments. What we're really doing is just redirecting the $100. $50 in principal, a little bit less than that toward interest. We can increase the principal payments if we want here, but you'll see what I'm doing. Now we can do the exact same thing. Look at it year by year and compare my growth to the loan interest payments. Do the same thing with the gains. If I pay the loan down faster, what's going to happen? I'll pay less interest, obviously. But this is a workbook we looked at here. So we can see how much am I paying in loan interest, and I can compare it again on a yearly basis to the growth. Some people like to look at the total gain. Everyone has a different preference. So in my mind, make it all available. And if I don't want to see certain reports, I can just condense them or get rid of them. Same thing with the death benefit. When the loans are taken, you'll notice that drop. So we've got $700,000 outstanding in loans, and there's the $700,000 reduction in total life insurance. So if I die with that loan outstanding, that represents the net amount that my beneficiaries will receive. But overall, that's what we did for him. Stage 1 was, again, what we've got up here, reviewing multiple companies and products. But once he narrowed things down and he said, here's the company I like, here's the product I like, here's the dollar amount I want to add, I'm just not certain what I can do after I get this lump sum in. Can I see some different options here? Really how that came up was a conversation and mentioning, here's what other people often consider, or here's what has helped them or has really helped give peace of mind, seeing what it looks like if you max fund nothing, maybe somewhere in the middle. This way you can just see, all right, here's what my numbers should look like. Of course, we'll track the performance as time passes, but it really helped give him peace of mind and helped him understand, all right, I'm knowing what I'm getting with this product. And then step 2 was seeing what it looks like when the money's in action through policy loans and such. So I hope you enjoyed this video. Let us know if you did. Please hit the like button, subscribe for more. Please leave any questions, comments, or thoughts below. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.